So here's the question. If you had $100,000 to invest today, would you put it in SPYI, QQQI, or OMAH? In this video, I'm putting these three popular monthly high-dividend ETFs to the test to see which one actually wins. I'll break down how each one truly performs, how much they pay, how fast they grow, how risky they are, and what type of return you can expect if you invest a one-time sum of $100,000 into these ETFs over the next 1, 5, and 10 years. And in the end, I'll show you a winner that can potentially turn this $100,000 into a $500,000 portfolio that pays over $2,800 in monthly dividend income. Before we jump into the results and start running the numbers, let's take a closer look at the three ETFs we're comparing, each with a strong focus on monthly income, but each one takes a very different route to get there. Let's start with SPYI, the NEOS S&P 500 High Income ETF. This one's built around the S&P 500, which includes 500 of America's biggest, most established companies – Apple, JP Morgan, Johnson & Johnson, you name it. SPYI takes those stocks and adds an options overlay, specifically by selling covered calls on the S&P 500 index itself. That move creates extra income from option premiums, which is why its yield looks so high compared to a regular S&P 500 fund. There's a trade-off, though. Because of those call options, SPYI gives up some upside when the market rallies big. But here's the part that many investors love. Its distributions are tax-efficient, with a good chunk classified as return of capital, or ROC. In simple terms, that means you might keep more of what you earn after taxes. SPYI is all about consistent, diversified, and tax-smart income, a mix that appeals to investors who like balance and predictability. Next up, we've got QQQI, the NEOS Nasdaq 100 High Income ETF. It uses a similar idea, a covered call strategy, but applies it to the Nasdaq 100, the index loaded with the biggest tech powerhouses like Microsoft, Nvidia, Meta, and Apple. Because tech stocks tend to move faster, QQQI can swing a little more in price, but that also gives it a bigger compounding potential. What